Today I would like to analyze Chipotle, one of the largest restaurant companies in the world. If we're going to take a look at the stock price, we are up 193% in the last 5 years, but in the 6-month chart we are down close to 22%. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 69.24 billion US dollar. This makes Chipotle the second largest restaurant chain in the world by the market cap. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 5.98 billion US dollar. This was a 7% increase from 2019, so a decent growth. In 2021, we saw the strong growth around 26%. Then in 2022, we saw the good growth around 14%. In 2023, again around 14% growth, and then in 2024, again around 14.6% growth. So overall, what can we say? I think we had a good revenue growth in the last 5 years, and it's a check here. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 0.29 billion US dollar. This was a 25% decrease from 2019, so probably related to COVID. Then in 2021, we saw the strong comeback with a 189% growth. Then in 2022, we saw the very slow growth around 0.53%. But then in 2023, we saw the strong growth around 44%. This is something we like to see. And then in 2024, we saw the decent growth around 23%. So overall, I think this company had an incredible growth in the last 5 years. So it's a check here. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 1.51 billion US dollar. Then we're going to divide it with the current market cap, 69.24 billion US dollar. And then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 2.18%. So I think this is a low free cash flow yield. It's under 4%, so it's not a check here. But of course, this company is also quite young and we can expect the free cash flow to grow in the future. So I think we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2025, the free cash flow could be around 1.6 billion US dollar. In 2026, around 1.79 billion US dollar. And in 2027, around 2.3 billion US dollar. So I'm not sure if these numbers are realistic, but let's assume for 2027 the free cash flow could be around 2.5 billion US dollar. Let me know in the comment section if this number is realistic. So then we would get a different free cash flow yield. We're still going to use the market cap of 69.24 billion US dollar. So the free cash flow yield that we would get would be then around 3.61%. So again, it's under 4%, so it still could be an indication for overvaluation, but we can see the free cash flow yield would look already better if the free cash flow can continue to grow in the future. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. A very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So we're going to take the long-term debt first. We can see here around 4.35 billion US dollar. Then we're going to add the short-term debt as well. We can see here around 0.28 billion US dollar. Then we're going to divide it with the current free cash flow. This is around 1.51 billion. And then we're going to get the debt to free cash flow ratio that we're looking for. So the number we're going to get would be around 3.06. So in a little bit over 3 years, we can repay the debt with the free cash flow. So this is a good number, is a check here, and we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 1.41 billion US dollar, and this is a great amount as well. So overall, I think this company has a great balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. This is the current market cap, 69.24 billion. We're going to add the debt. This is around 4.63 billion. We're going to take minus the cash. The cash is around 1.41 billion. So then we're going to get the enterprise valuation for this company. So the number we're going to get would be around 72.46 billion. So this is how much the whole company is worth. Then we're going to divide this number with the current free cash flow, 1.51 billion. And then we're going to get the ratio that we're looking for. The number we're going to get would be around 48. So this number is quite high. This could be an indication for overvaluation. So we want to see that number actually under 25. So, but we can also calculate this number for 2027 with our free cash flow around 2.5 billion. So then this number would look already better actually. So the number we're going to get would be around 28.98. So this number looks already better. It's close to the number 25. And I think this company could be fair valued right now if we expect the free cash flow to continue to grow after 2027. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that especially if we think the company is undervalued. So we can see here repurchase of common stocks. And yes, this company buys back a lot of their shares. So it started in 2020 with around 100 million US dollar. And then in 2021, they increased it around 500 million US dollar. And in 2022, it was close to 1 billion US dollar. Yes, this company does a lot of buybacks, and I also think this company can afford it because they have a good balance sheet as well. I would like to give my conclusion about this company, so let's start with a positive. So I think we had a good revenue growth in the last 5 years. I also think we had a great free cash flow growth as well. This is something we really like to see. The balance sheet is also looking quite good. This means a low amount of debt and a good amount of cash on hand. We also have stock buybacks, so this can help the stock price to increase as well. The free cash flow yield around 2.18% is looking quite low. So this could be an indication for overvaluation, but of course we're expecting the free cash flow to grow in the future as well. So then in 2027 with our free cash flow assumptions, we would have a free cash flow yield around 3.61%. So this would look already better. Our enterprise valuation to free cash flow ratio around 48 could be again an indication for overvaluation, but with our free cash flow assumptions for 2027, this number would be around 29, so it would look already better again. And I think this company could be a good buy if you really expect the free cash flow to grow in the future, and if you expect the free cash flow to continue to grow even after 2027. So I think this company has a very high expectation. So if they cannot meet this expectation, I think the stock price could decrease a lot as well. If you found this video helpful, don't forget to like and comment and subscribe for more content.